What is factor investing? And will a factor investing strategy beat your portfolio's current investment strategy? Here we go. Welcome to the Forget About Money podcast, where we encourage you to take action today so that you can focus on what matters most to you. Joining us today is Dan Huffman, a financial planner and founder of Cornerstone Financial Planning. Dan discovered the financial independence community in 2015 while serving as an Army physical therapist in Afghanistan. Motivated by his passion for financial literacy and desire to spend more time with his family, Dan transitioned from active duty to the reserves in 2021 to pursue a career as a financial planner, helping others achieve financial freedom and live intentionally today. Welcome, Dan.
Hey, David. Thank you for having me. I've been a big fan of your content for a long time.
I appreciate that. Thanks. Dan, today we are exploring factor investing, an investment strategy that focuses on specific drivers like value, size, and momentum to potentially enhance portfolio returns. We'll discuss how it compares to traditional passive broad market index investing and whether it's worth considering for your portfolio. We'll also touch on the risk and rewards of factor investing and how to apply it in today's market. But before we get into all of that, Dan, because of your line of work, you have to provide a disclaimer. So let us hear it.
Yeah, so the information shared is for educational and informational purposes only and should not be considered financial, investment, tax, or legal advice, nor is it a solicitation or endorsement of any specific company, security, or offering. So consult with a qualified financial professional for advice tailored to your individual situation. Past performance is not indicative of future returns, and I do not guarantee the accuracy of the information provided. The opinions expressed are my own and do not necessarily reflect those of any affiliated entities. Thanks, David.
Well, anything that prevents you from getting sued is great with me. So let's get right into factor investing.
Yeah.
What is factor investing and how does it differ from traditional market investing?
So I'll start with traditional market investing. Typically, and this is how I learned how to invest, people just invest in mutual funds, or especially in the financial independence community, we do think about broad market index funds. And ever since Warren Buffett endorsed the S&P 500 as a standalone portfolio, basically, with 10% bonds, he said, people have really jumped onto the simplicity of that. And then with J.L. Collins publishing The Simple Path to Wealth and endorsing Vanguard's Total Stock Market Index Fund, a lot of people, I think, were just immediately drawn to how simple it could be to invest and to get a great long-term return from investing in the market. So that research and the reason why those two recommendations from those two, I'll call them celebrities, why they work is because of what we call the efficient market hypothesis. And so we know that it is very difficult to beat the market. And so for decades, people have accepted the market as the standard of return. And then they've looked at portfolios that either beat the market or underperform the market. And they would compare those to the market to try to explain why one portfolio did better or why one portfolio did worse. So traditionally, what it looked at is how stocks and bonds kind of interact together. So when we think about very basic asset allocation, we typically think of the ratio of stocks and bonds in the portfolio. And then people determine that, and then that's what they invest in. And that's kind of explaining most of the return that they'll get over a long period of time. Factor investing, I would say, goes one level deeper. So it's not as simple as just holding the market and chilling for the rest of your life, but it's really more so, we'll say, on the stock side. How can we diversify our stock holdings and perhaps improve our long-term returns? Or also looking at the bond side, because there are some factors on the bond side that also have lended towards higher returns over time. So it's really getting a little more granular on each side of the investment pie, we'll say, and then trying to do better there.
Okay. So we talked about, the index fund was, I guess, invented in the late 70s by Jack Bogle. At least that's what I believe. I think that's true.
Yep.
And that's taken up, and rightfully so, for many reasons. There's a lot of value in that, of course. But you're saying there's something else that maybe we should be considering to get some more dynamic returns out of a portfolio for long-term retirement investing. How do factors start? Like, where did this research begin? And who was the first people to come out and say, hey, but what about these things like momentum and size, and then figure out the dynamics between them, and then how that affects your portfolio return over time?
Yeah, so those are great questions. And honestly, I think my personal evolution as an investor kind of mirrors that of history, even though it's completely incidental how I stumbled onto factor investing. But you mentioned I was deployed back in 2015, and I was actually teaching a financial literacy class, an investing class for the young soldiers on our FOB.
Mm-hmm.
And I was really diving into my own investments at that time. And
FOB, let's pause there. FOB means forward operating base.
That is correct.
Okay.
And I was not a FOB-it. I left the base often. So no jokes to any of the people who did not. But what I started to notice as I was diving into the investment research was that over very long periods of time, small cap stocks tended to beat large cap stocks. And so I thought when I saw that, wow, I'm a genius. I'm going to, start investing in all these small cap stocks and I'm going to beat the market, we'll say, over a long period of time and get a higher return. Well, as my investing education, I guess we'll say, continued to progress, I actually started a blog back in 2017, and it kind of forced me to dig deeper into this research. And it turns out there's actually some pretty fascinating history to it. And small cap stocks were one of the first, what we'll call anomalies in the stock market that was ever discovered. So historically, again, if we go back to like the 1950s, 1960s, there was some pretty basic but yet groundbreaking research, because this was the first time people were actually researching investing. And what they were showing is that it's really difficult to beat the market. And so this is going back that long that we've known it's tough to beat the market. And so there was this asset pricing model called the capital asset pricing model. And what it was able to do that was so groundbreaking was it was able to describe the difference in returns between two different diversified portfolios. The problem was that it could only explain about 2/3 of the difference in a portfolio. So let's say, David, that you had a portfolio and I had a portfolio, and your portfolio beat mine. We could put them both in the capital asset pricing model. Yeah, I know, you get the higher return there. And we could explain about 67% or roughly 2/3 of why you beat mine. The problem is we couldn't explain the other third. So for a long time, people thought, well, it's because David's a better stock picker than Dan is. And so that seemed to maybe hold true. And that was one of the reasons why actively managed mutual funds at that time were able to kind of grow in support, because, they had the expert picking funds that could beat the market, we'll say. That was their goal, right? But what happened was kind of in the 60s and then into the 70s, Eugene Fama and Kenneth French, which are professors at very well-known universities, Dartmouth and University of Chicago, they began doing a little more specific research, and they basically came up with the efficient market hypothesis. And so they were the ones saying that the market represents all the known information at any given time. And therefore, it's very, very difficult to, again, beat the market. But what they started to do is they started to incorporate more, we'll call them factor models, into their research to try to explain away that missing third of our ability to explain the difference in portfolios. Mm-hmm. And so during that time, another researcher, he found that small cap stocks tended to beat large cap stocks. And so that was kind of one of the first anomalies, we'll say. And so the question in investing becomes, like, we're taking risks to get a return, right? So the question becomes, do small cap stocks have unique risks that would make us believe that they should beat large cap stocks? And if so, is that consistent? And so that was in the early 1980s. And it turns out that at that time, they did determine that was true. Small cap stocks have inherent risks that are different than large cap stocks, that mean that investors in small cap stocks over long periods of time should expect to beat large cap stocks. And so that became what I consider the first official factor. So we call that the size premium, simply meaning that over long periods of time, small stocks beat large stocks. Now, without getting into too much nuance on the size factor, it is actually the weakest of all the factors today. But what's unique about the size factor is that all the other factors have larger effects in small cap stocks than they do in large cap stocks. So again, while I tend to not get caught up on small cap as much as I used to, I do understand and appreciate that, say, value or some of the other factors that we'll talk about, they tend to have more robust returns in the smaller stocks.
Okay, so size matters is what you're saying. And it's
Actually, it's funny you say that, David, because there's a very popular article I like that is called Size Matters If You Control Your Junk.
All right. Maybe we'll link to that in the show notes. I'm not sure exactly what that's about, but if it's legal, we'll put it in the show notes.
It's a fascinating study, trust me.
Small cap value in particular seems to be one of those next level topics that people who are smart about money want to talk about, and they will make solid claims. And I know Paul Merriman, who at the time of this recording, we just recorded an episode a couple of days ago, and it will go out probably, if somebody's listening this, a couple weeks ago. He is a huge advocate of small cap value, but at the same time, you've got people like Big Earn who are not. Big Earn is a huge sequence of return, I would say expert. I don't know anybody who's done more work. Maybe Michael Kitces, maybe not. I don't know.
I think
Carsten Jeske
wins the title.
Yeah, I think so too. But he's against it. And his argument is that over the last 15 years, small cap has not outperformed. And I'm not sure exactly what it hasn't outperformed. I think just the broader market in general maybe is his argument. So why do the extra work, maybe extra work in air quotes? Some people like this stuff. It's not considered work. Why do those extra keystrokes for something that has not been valid for a number of years? So I understand both arguments, but we're talking about small cap value. But small cap value is not the only factor. Can you just define a factor in like layman's term and then tell us what like maybe the most popular factors people look at in this context?
Yeah, definitely. So factors, if we want to think about, again, with investing, we're coming to a risk versus a return, right? So I think in the most simple of terms, people invest in the stock market rather than the bond market because they expect a higher rate of return from the stock market. And that's a risk-based return. We'll say generally, bonds tend to be less volatile. They're a little bit safer, we'll say. And I'll say, safer in quotation marks, right? Because we all saw what happened in 2022.
Mm-hmm.
But in general, we expect a higher return from stocks because of the unique risks of stocks versus bonds. Well, factors are the exact same type of risk, but within the stock side or within the bond side. So when we look at some of these other unique factors and risk factors that determine a potential higher return in the future on the stock side, again, we see the market. That was kind of the first factor, and it was that stocks beat bonds. The second factor was size. Small cap stocks tend to outperform large cap stocks. The third one was value. So companies that are trading at low valuations tend to outperform companies that trade at higher valuations over long periods of time. So where Fama-French really improved on the capital asset pricing model was that they developed a 3-factor model. And that 3-factor model drastically improved the explanatory power between those two portfolios. So if we go back to the example of your portfolio, David, versus mine, after using the Fama-French model, what we could say is David's portfolio beat Dan's portfolio because he had more small cap stocks and more value stocks, but it still wasn't perfect. So later on in the 90s, Fama-French actually came out with a 5-factor model. And so along with value and size, they ended up adding what's called profitability, which are companies, this is going to sound like a no-brainer, but companies with strong profitability, stable earnings, low debt, they tend to beat those companies with high debt and other, less financially sound, characteristics over the long term. And then investment. So investment's a factor that companies that invest less into their company tend to over time outperform those that might be rapidly just raising money, throwing it into their company, into like research and design. And then those companies that rapidly do that tend to fail at a higher rate. So low investment companies tend to outperform the higher investment companies. And so what Fama-French found is after controlling for all 5 of those factors, the market, size, value, profitability, and investment, they were able to explain about 90% of the difference between our two portfolios. So what this did is it greatly diminished the benefit of stock picking. Because now what they're saying is if we can, in advance identify those companies that display these characteristics and then build index funds around them, we should be able to help the everyday investor get better exposure to these types of stocks that we believe over the long period of time will outperform their opposite. So that's really where those different factors came into play. Now, you did mention this, but momentum is another factor. So there's kind of two factors that aren't included in the Fama-French data. That's momentum, where stocks that have been doing well recently continue to do well recently. This is actually the most robust of all the factors. The challenge is capturing it. So Larry Swedroe actually has a really good book, and I always butcher the name of it, but here it is, Your Complete Guide to Factor-Based Investing. And he lays out all these criteria for what it takes to be we'll say a valid factor. And one of them is investability, but basically the ability of a fund to capture the return and do it in a tax efficient way and like a cost efficient way with trading cost. So momentum is one of those that definitely is very robust in the research. But when you account for trading costs, because it's a high volume trading strategy, it does diminish the return a bit, but it's definitely still there. And then another common factor that people see is low volatility. And that's stocks with less price fluctuation doing better. So on a recent podcast, you had Frank Vasquez on, and I think he was talking about this a bit with the different approaches that he uses. And low volatility would be one of those that would probably make sense in that type of portfolio because it diversifies, and what doesn't go down as much doesn't need to go up as much to recover either. So those are the main stock factors. Those are what are believed to be unique risk inherent to some stocks in the market, but not all stocks. So the belief is that by overexposing your portfolio to those types of stocks over a long period of time would generate higher portfolio returns.
Okay, makes sense. Makes sense academically to me. Now, you mentioned that perhaps if a mutual fund could be built around these principles, it has the chance to beat the just S&P 500 buy and hold strategy. If all of the studies have been done on factor investing, and it seems like they're fairly thorough, and we do have the ability to research and backdate test all of these things, I'm assuming fund companies have come up with mutual funds that represent this style of investing. Is that true?
Yeah, it definitely is. So, again, this is not an endorsement of any one company, but Dimensional Fund Advisors was begun in the 1980s on this entire premise. And so I have a ton of respect for them, and they've published a ton of the research in this area since they came out. So there's a handful of good companies that really do try to produce this type of research and then also provide the funds that people can actually invest in to capture the risk premiums of these factors. One thing I wanted to mention too is, you mentioned Paul Merriman, and Paul Merriman was very influential in my journey as well, because around the same time I was learning about this on my own, I found him in the financial independence space. And so he really connected some of those dots for me. And what I appreciated about Paul Merriman is that I think he was growing as an investor when all of this research was brand new. So I think he was really ahead of his time in how he invested. And at the time when he was being an investment manager, it was all actively managed mutual funds and maybe just a couple index funds. Like you mentioned, the S&P 500 index fund goes back to around 1974, I believe, but it didn't really become popular until much later. And so, Paul Merriman, I think, has a tremendous amount of knowledge and expertise on this. Mm-hmm. And then I also wanted to comment on, Big Earn, because I have a ton of respect for Big Earn as well. And I've always been kind of puzzled as to why he wasn't, a big fan of factor strategies, because he is so smart. And so I can't speak for him, but based on what I've read, what I'm seeing is that, we always give the disclaimer, past performance doesn't guarantee future results. From what I've seen him write on his blog, it seems that he thinks this is more of a product of backtesting the data and saying, well, of course, if we look in our rearview mirror, we know which horse won the race every single time, right? But the challenge is, can we identify that horse or the top three horses moving forward, right? So I think that his take is that this is more letting our future investment decisions be based on history. But I'd say that the difference that I see in the Fama and French research is that they include a long period of time in their research. So they're going back to 1926 through the present, and they make all their data publicly available on Ken French's website. So researchers around the world can literally do this analysis on, up-to-date data basically every month. And what they found is that there are multiple periods of time in which factor strategies fall out of favor. And that's when we would say maybe the past 15 years, value did terrible, growth beat value. So there's all the headlines like, is value dead? Well, historically, value's been dead like 5 times, or multiple times. And that's exactly one of the reasons why it's believed that the value premium will survive, because it falls out of favor. And when it falls out of favor, it's poised for the biggest comeback. And we actually kind of saw that since COVID, with value stocks going on to come back and beat growth. So the way I look at it is, I do think we have to be cautious, like Big Earn is, about just betting that, the factors will beat the growth, or that they'll beat the S&P 500. I think we need to be cautious about how we anticipate that happening in the future. But what I think makes sense is knowing that it does come and go. There will be periods of time where value beats growth. There will be other periods of times where growth beats value. So of all the factors too, value is probably the most popular, because Warren Buffett, we all know Peter Lynch, there's famous value investors, right? But profitability is a growth strategy. So going back to 1926, there's been no 5-year periods with a negative return between a value and profitability blended strategy. That's huge. So being able to look at that and think about, well, how could I construct a portfolio where at least a portion of my portfolio has historically had a very strong 5-year return? To me, that's a huge value add. But again, can we guarantee that there's no 5-year period that's negative in the future? No. But I always think of Mark Twain's quote, history doesn't repeat itself, but it often rhymes. Like, I don't know what the future holds. I can't guarantee what the future holds. But I do think the factor strategy and combining some of these factors in a portfolio, I do think that will make things better. But I can't guarantee it, and I can't guarantee by how much. But I do think over a long period of time, it improves the odds.
Okay. If somebody's made it this far into this particular podcast, they very likely enjoy this stuff and is inclined to, I don't want to say tinker because that gives a negative connotation, but to make moves in their portfolio for justifiable reasons rather than just fire and forget into a broad market low cost index fund. Yep. Is that how, let's say somebody who doesn't know anything that we're talking about made it this far into this conversation, is that how we need to divide like the groups of people up, the people who care about the stuff, or I don't say care because everybody cares about their money, but the people who are inclined and want to learn more to do these extra keystrokes for this potential return, and those who just want to live their life knowing that just a simple fire and forget strategy like VTSAX and chill can get them 90% of the way there or 100% of the way there, whatever they decide is enough. Like, how I can understand, because somebody could be listening to this and be like, that's just too much work. I don't understand it. Moving on. Like, are they lost? Are they just going to be missing out? I don't think so. I think everybody's different, right? But I'm saying all this because I do really think it's just like, if you have these if-then statements in money conversations, one of the very first questions is, do you enjoy managing money? Yes or no? If the it's no, then we're going to go through this way. And like, okay, maybe here's some strategies that might fit into your lifestyle, into your temperament, into your personality better. And if it's this, then no, let's educate you on this other, simple path to wealth like J.L. Collins. But there may be another way for you in particular. Is that how you see it when you're having conversations with people?
Yeah. So I don't think that everyone should probably invest with the factor strategy. I do think it requires some extra level of a little bit of learning and understanding and openness. But what I will say, back in the day when I was blogging, this always cracked me up because I would take so much flack for having such a complex portfolio, right? And I was advocating for like 3 funds or 4 funds at that time. And what cracked me up, though, is that the people who are against it are all in on a broad market index fund. And that's factor investing 101. Like, the market is the original factor. So if you believe in that, you should automatically believe in the exact same premise for every other factor that's there. The same research that says you should hold a broad-based market index fund is the same research that says perhaps a value tilt makes sense, perhaps a size tilt makes sense, and on and on. And again, this isn't portfolio or investment advice to anyone listening, but this is where I think people need to start questioning, like, does that make sense? Or how come I don't view it like that?
But even if it does make sense, then the next step has to be to put it in practice. And that's where some people just don't want to.
Yeah, definitely. But, I feel like people move money to high yield savings account to get an extra few percent versus leaving it in their bank, right? Like, that takes more effort than me investing how I invest.
Okay.
So it's really, if we're talking about a 20 to like 50-year time horizon for people, this could make a massive difference. It historically has made a massive difference. But again, I don't believe the past will exactly replicate itself.
All right, Dan. So we have the simple path to wealth where a person would just invest regularly, dollar cost average into an S&P 500 or another low cost broad market index fund over time. But that's the same keystrokes as if you were investing into a mutual fund that represented and used factor investing. How do the two perform? Because that's still simple. It's just you're just investing in something else that should be tilted or should have additional risk profile in order to gain a few percent, maybe even a year over time.
Yeah. So this is where it goes to the back testing. So we can look back and see how things performed. Now, again, the limitation of back testing is that this doesn't guarantee that the future replicates the past exactly. But again, I like the Mark Twain quote, I don't think it'll replicate itself, but I think it'll rhyme. Now, the risk is that it doesn't. And that's the biggest risk of factor investing, is that I take these risks today. I make this assumption that factor investing is true. I invest like this. And then in 50 years, towards the end of my life, I'm like, dang it, I should have just done something else, right? So that's the risk. But I believe that we're going against a lot of the academic research that does get at the persistence of this strategy. And so that's where we look at it. So again, simply back testing the broad US market from 1972 through the present, which is, we're in September of 2024 now. And I use Portfolio Visualizer for this if anyone wants to play around with this at home. But if we were to compare two portfolios, one, which would be, I'd say, a basic factor strategy, kind of using the Fama-French 3-factor model, but I'm not going to get too specific on that, versus the broad total market index, the annualized return, so the compound annual growth rate per year, is 12.50% for the factor strategy and 10.72% for the broad-based market. So over those 53-ish years that we're hitting now, the factor strategy has beaten the market by about 1.7% per year. And that's huge. That's a massive difference over 50 years. Now, over those 50 years, what's important to remember is that includes the last 15 years or so, where ever since like 2000, maybe the mid 2000s before the global financial crisis, value started falling out of favor and growth beating value. But it should also be noted that from like 2000 to 2009, value did great. In fact, one of the reasons I became a factor investor was analyzing how a factor portfolio performed during the dot-com bust from 2000 to 2002, and it drastically outperformed the market. It was hugely protective. And so that's one of the risks of holding just a pure market fund as your entire investment. You could have a lost decade in retirement, and that would be catastrophic. That's why I believe in, diversification beyond just that. Yeah, so coming back to just the returns, the returns can be significantly different. But again, I'm not going to ever guarantee that the next 52 years, the strategy would beat the market by that much again.
Okay. And so this follow-on question might be not a fair one, because you said this was what you just explained was 53 years of research and back testing. And we only have the 5-factor model since the mid-90s. And then the establishment of mutual funds that trade in this style. Since mutual funds have been established, have those mutual funds beat the S&P 500 index?
Yes. So the question is, what are we trying to beat? So if we're using the S&P 500 as a benchmark to beat, a lot of people, I think, just pick that because it's the best known index. But in reality, picking a benchmark to compare your portfolio to gets a lot more complex than that. But I do think at the highest level, if people want to think about the S&P 500 or, a total market index fund as being the benchmark, they can do that. But that's where over time, there will be years where this strategy beats that. And then there will be years where that beats the strategy. Again, this strategy, like every portfolio I do put together, I will share this. The S&P 500 is a component of that portfolio because that represents the market in the factor strategy. So it's always the market plus some other factors. The index, the fund costs range. There are some funds that are as cheap as like 0.07%, And I think the most expensive one that I recommend that I use is 0.25%. So it does go up quite a bit. The returns have also justified that. And so the after expense return would have still beaten their opposite. But just remember too, when we're talking about, say, small cap value versus the S&P 500, that is not the comparison that's being made in the research. It's really more like small cap growth versus small cap value, or small cap versus large cap. It's not, some arbitrary 100% benchmark. So a lot of the academic research, they go long, we'll say, in something like small cap value, and they would compare that to a portfolio that's long in the opposite of small cap value. So again, like high expense growth stocks. And so that's a difference that I do see between, we'll say, DIY investors versus how I would say a benchmark for a portfolio should be made. But I also look at it from an opportunity cost. And if you adopt a factor strategy, the opportunity cost is that you're not in like a broad market index fund that costs 0.03%. So there is a difference in that. I think for me, I look at the long-term academic research, which is again starts back in 1926 and goes through the present. And I see multiple periods of times in which the factor strategy has been awesome, and then when it's been pretty terrible. But all in all, throughout all that time, with all those periods of underperformance, it still tended to beat the market. It still has beaten the market over that long period of time, or it's beaten their opposites over that long period of time. And so for me, I've decided that that's a risk I'm willing to take. But it could be that the next 30 years, my strategy fails and I would have been better off having, invested differently. But that's a risk I'm willing to take, and we all have to take those risks.
Okay, can we prioritize? Can you just list the five? We don't have to go back in and redefine them, but can you list the 5 factors that were in the 5-factor model, if this is also what you think is still currently relevant today? And then again, I don't want you to necessarily say what you personally have tilted in your portfolio or not, but could you talk about which of those 5 factors actually matter more and are easier to track and maybe implement if somebody's interested in factor investing?
Yeah. So again, the 5-factor model included the market. So think broad-based index fund like S&P 500 or total market index fund. And then size. So we're talking small cap stocks. Value. Again, the low price to earnings, low price to book type metrics. And then investment, which was companies that have lower rates of investment tend to do better than those with high. And then profitability, with companies that are higher profitability tend to beat those that are lower profitability. And then the 2 that I mentioned that weren't in the 5-factor model are momentum, which is those stocks that are doing well recently continue to do well for at least a time. And then the low volatility stocks tend to beat high volatility stocks. So I think if people are interested in those, there's really good research on those. So if they Google those, check those out, if there's something that makes sense, then I think that it could be a reasonable thing to investigate further and try to find out how that might fit in their portfolio. But what I would not do is just blindly say, I'm going to go grab all 7 of those and slap together a portfolio, because inevitably the market will beat it and they'll be like, shoot, now I'm going to sell. And then they'll sell right before that portfolio goes on to beat the market. And to me, that's just like the people who try to trade actively managed mutual funds, always underperforming the mutual fund by about 50%. So this is not a chasing returns type of strategy. I think this only works as a good buy and hold long-term strategy that you're comfortable with.
Okay, so let's say I'm a diehard FI fan and I've got a couple $100,000 in VTSAX or S&P 500 or broad market, and I hear this, I'm like, okay, well, I know I'm pretty well set. So but I'm interested in this factor investing. Would a conservative or smart way, or however you want to characterize that decision, would be to just add and continue doing what you're doing, but then add a mutual fund or ETF that prides itself on one of these factors? And if so, what's the factor that actually is a small cap value? I mean, is that the one that you'd probably gain most of as far as the delta if you were just to add that to your overall portfolio?
So yeah, I will generally and cautiously say small cap value seems to be where the most attention is. I'm not going to endorse that as the one. Paul Merriman certainly does, and I'm a fan of Paul Merriman, so I'll leave that as that.
Okay.
But I do think just taking it one step at a time makes sense. again, kind of my own educational evolution, as I was sharing earlier, I went from the market to small cap to some value. And like each time I learned something new, it made sense. And then when I put it together, the whole puzzle started to become more clear. And so I do think for anyone who's listening to this that thinks it may make sense to them, I would just say start researching it. And I think the research will lead you to where you want to be. Now, one thing I will mention though is, what is the difference between holding a broad-based market index, total market index fund, where you own all the stocks, as everyone says, versus these types of funds where you only own some of the stocks? So all of the stocks that I own are held in a total market index fund, right? The difference is that what we're doing is we're tilting by overweighting our portfolio towards these types of stocks. So rather than getting the market capitalization exposure of what that actual stock, fits into the entire stock market of the US, we're overweighting these stocks in our portfolio. So that's the only way to actually harvest or realize this excess return in proportion to how we overweight it. Or if you underweight them, that's also the way to, not get this return and get more of the market's return. So I think I like for people to realize that they already own all these stocks if they hold a broad-based market index fund, maybe like Vanguard's total stock market index fund. The S&P 500 doesn't include most of these, but if they do hold a total market index fund, they already own these stocks. What I'm talking about is overweighting some of those stocks beyond their market capitalization weight.
Yeah, based on the factor.
Yes, based on the factor premiums that lead us to believe that historically, over long periods of time, these types of risk go in favor and out of favor. And usually after they've been out of favor is when they come back, they tend to have the biggest return. And that's why this is a long-term approach and really tough to time.
In your own journey and in your future practice as a certified financial planner or financial planner, I don't know that much about your history or even your philosophy on investing other than this conversation today. What are some of your personal/professional philosophies about money management or investing that you want to make sure people grasp? It doesn't necessarily have to be related to factor investing.
Yeah, that's a good question. I do think when it comes to investing that for me, it has become important to not just take the first step, I think. That is kind of why when I had my blog back in the day, I was kind of on a crusade almost against holding just a single total market index fund. Now, I do think I've come maybe full circle to where I'm like, that's totally fine if that's what people know and understand. I think understanding and believing in your investment philosophy is by far the most important thing, because that's how I know you won't bail when things look rough. But what I'm a big believer in is that if you just learn a little bit more, I do think you can probably, and again, no guarantees, but probably improve your odds of a higher return over a long period of time by just not going to the simplest level possible. When I used to talk about this, people used to bring up Occam's razor, where the simplest solution is the best, right? So that sounds great when you have two competing equal opportunities or problems to face. The problem is that that's been disproven in math, philosophy, computer science. Pretty much every field of study has disproven that, to where it's actually a more complex answer is actually the best answer. What I would say is if complexity adds value to your situation and it makes sense, then kind of go with it. But if it doesn't make sense, then absolutely do not.
Do you think you're going to be able to stick with this strategy throughout your own lifetime?
Yeah, I definitely do. I'm 100% bought in. But again, that's me, and that's based on my understanding. And I think one of the areas, we joked about that paper earlier with the awesome name that size matters if you control your junk. I read those types of academic papers. And so those
academic papers. Yeah.
It is. Trust me. You can share it. Okay. But, I like that stuff. And as a physical therapist in the Army, I was very big into evidence-based medicine and just doing my best for my patients. And, I think I could critically read a paper and know its flaws and know its strengths and how I could apply it to the patient in front of me. And that's kind of how I view this as well. And so, I do believe I'll stick with this for the long term. It would take a lot to convince me otherwise, but I also need to be open-minded that could happen. That is a risk.
Yeah. So I think, I'm not sure what number podcast this is for me, maybe 39 or 40, but one of the themes that one of the early epiphanies I've gotten from interviewing people on this podcast, Rick Ferry, Dr. William Bernstein, Paul Merriman, they all agree on one overarching philosophy. And this is really like taking a bigger weight in the way I look at things too. The best investment strategy is the one that you are going to stick to.
Yep.
Period. It's not this 1% here. It's not the 2% there. Because if you're not going to stick to it, all the back studies don't matter. It just doesn't. So I think that's really made a significant impact on how I shape even these conversations too.
Yeah, absolutely. Yep. One mistake I made when I was first learning about factor investing, I thought it was so awesome. So I found this great fund that I thought would be good and it had a great history and a great long-term return, right? So I invested in it. It didn't do well. It got beat by another fund I had. So I sold it. And then that very next year, the fund did 28%, while my other fund that I had bought did like 18% or something. So the market was up big no matter what. But that other fund killed it. And I was just like, you know what? I was trying to be too smart. I bought in and then I questioned myself. I jumped off the roller coaster, as Warren Buffett says, and that's who gets hurt. And so, yeah, now I'm more just set it, forget it, but make sure it makes sense to you. And for those in the accumulation phase, continually investing is huge. So your savings rate, probably the most important thing. I think this is more of kind of a secondary, let's optimize what we're saving into for a long period of time. Yeah. But that's how I view this.
Yeah. And actually, I was going to say that it's one thing for us to focus on like graphs and data points and this fund versus that fund and back testing and portfolio visualizer. But I don't know anything, unless you just routinely pick individual stocks that go to zero. I don't know anything that's going to affect your overall portfolio success than your savings rate. Yeah.
Absolutely.
Yeah.
Absolutely.
Well, Dan, thank you very much for being an incredible guest and sharing your valuable insights on factor investing. It's good to finally meet you. I know you and I went back and forth maybe a couple of years ago, and we were talking about TSP, and then you reached back out when you discovered I had the podcast. I'm glad we're having this conversation and we got to reconnect. And I appreciate your time and expertise. Thank you for joining.
Yeah, thanks for having me, David. It's been great talking.
And thank you all for watching and listening.